Welcome back to the deep dive. If you are preparing for the ACCA financial management exam, or, if you're in a management role that demands strategic decision making, you'll know that one of the most crucial functions of a financial manager is capital allocation.
Absolutely. The investment decision.
It's all about deciding where that precious, often really scarce capital is going to be deployed. Are we launching a new, untested product?
Or are we expanding a factory in a foreign country?
Yeah.
Maybe decommissioning an old asset and buying a huge new piece of specialized machinery.
It truly is the gatekeeper function of finance, and it's just a fundamental pillar of the ACCA FM syllabus.
It is. And every single one of those investment decisions relies on forecasts, on projections, and sophisticated models like net present value or NPV.
Right.
But here's the cold reality.
Right.
You can have the most accurate spreadsheet models, the perfect weighted average cost of capital, but if you put garbage information into your cash flow calculation, you're going to get a garbage decision out.
Garbage in, garbage out, exactly. And that brings us to the very foundation of those models today.
We are diving deep into the core concept that supports all investment appraisal, relevant cash flows, or RCF.
Yes.
Our focus today is laser-targeted for you, the ACCA student, and our mission isn't about deep arithmetic or being some kind of human calculator.
No, not at all.
It's entirely about mastering the judgment and the logical filtering required to sort the signal from the noise in an exam scenario. And trust me, that application of sound logic is where the professional marks are earned in Section C of the FM paper.
That is the essential insight we really want you to take away from this. The examiner in FM is primarily testing a candidate's critical thinking, their ability to apply principle over process. They want to see that you can separate the irrelevant noise, the historical figures, the non-cash entries, from the vital incremental data points. A mechanical adjustment to every single figure provided simply won't earn full marks. You have to demonstrate judgment, and you have to justify that judgment.
So let's start by establishing the bedrock rule. What is the supreme filtering principle that we must apply to every single number we encounter in a question? The bedrock rule of relevant cash flows is simple in its articulation, yet it can be devastatingly effective if it's misapplied. Relevant cash flows must be future, incremental, or extra cash flows that accrue to the company as a direct result of undertaking the investment.
Future, incremental, and cash.
Everything hinges on satisfying all three of those criteria. If any item fails just one of those tests, it is irrelevant and it must be excluded from your investment appraisal calculation.
Okay, let's start with Section 1 then, and nail down precisely why identifying RCF is the make-or-break element for the final investment decision, whether we're relying on net present value or internal rate of return. Why is this accurate filtering so foundational?
Well, because the goal of investment appraisal is, in a way, financial prophecy.
Right.
We're looking into the future to predict whether a specific, definable course of action, this project, will create value greater than its cost measured in today's money. The entire discipline of discounted cash flow methods revolves around comparing the initial cash outlay with the expected cash flows over a project's life.
So if you get the cash flow stream wrong,
You fail the prophecy. Simple as that.
and when you talk about getting the cash flows wrong, that leads directly to the two major, very costly errors in financial decision-making, doesn't it?
Absolutely. The first error is what we might call type I, the really costly one. Accepting a project that should have been rejected.
Okay.
This happens when you inflate the project's benefits or, more commonly, when you artificially understate the costs by incorrectly excluding something that is truly incremental. The project looks good on paper, but it actually destroys shareholder wealth.
And the second error?
The second error, type 2, is rejecting a project that was genuinely profitable. This happens most often when candidates and, financial managers in the real world unnecessarily burden a project with costs that are not relevant,
Like what?
like including a massive sunk cost or an irrelevant overhead apportionment.
I see. So the moment you include a huge historic sunk cost, for example, you're unnecessarily lowering the calculated NPV of the project, and you could potentially cause yourself to reject what was actually a genuinely good value-adding opportunity.
Yes.
You're essentially penalizing the future decision with the mistakes or the commitments of the past.
Precisely. And the examiner is looking for candidates who understand this strategic context. We are only concerned with things that change if and only if the project is accepted.
Okay.
This idea of focusing on change, on what is extra, is the true meaning of the incremental approach. We're interested in the margin, the difference between the company's cash flows with the project and the company's cash flows without the project.
That distinction, if and only if, makes the filter instantly applicable. So every cost item we see in the scenario needs to pass that test. Did this expenditure happen or will it happen, regardless of whether we press the go button on this new investment?
That is the exact mindset you must adopt. And this highlights a crucial examiner expectation. Candidates must focus on the financial consequences of the decision now.
Right. Not the past.
We are dealing with future cash positions, not historical accounting profits. Accounting figures so often include non-cash entries and apportionments that are completely irrelevant to the actual movement of money in or out of the company's bank account.
So the past is fixed. We're dealing only with the future consequences we are trying to shape, and those consequences must be real movements of cash.
That's the core of it.
Okay, let's unpack those 3 vital filters in more detail now. Let's take our time to explore the nuance of each one. They're the screen we use to filter every single piece of data in a complex exam question. Let's start with the one that I think gives students the most comfort. The future filter.
Right. The future filter is designed to immediately eliminate any costs that are already committed, what finance theory calls sunk costs, or anything that is purely historic.
And why do we have to reject them, even if they're huge cash outflows?
Because the money has already been spent, or the contractual liability has already been incurred, and your decision today cannot change that fact. They are irrelevant to the go or no-go decision because they are simply inescapable.
Okay, let's use that classic example from the source material. We're told about a research project that has already cost the company $150,000 to date. A student might look at that huge number and feel, compelled to include it, reasoning that the company wouldn't be doing this without that prior spending.
And that $150,000 is the textbook definition of a sunk cost. It's what we call water under the bridge.
Right.
Even if the project is abandoned right now, that money cannot be recovered through this appraisal decision. Therefore, when you're assessing whether to proceed with the remaining stages of the research project, that initial investment is completely and utterly irrelevant.
So the decision must be based solely on
the future costs and the future benefits generated from this point forward.
I think the real-world parallel is really important here. It relates to the sunk cost fallacy, doesn't it? We are often tempted to continue funding a failing venture just because we've already invested so much time or money in it.
Precisely. Finance tells us that emotion is dangerous.
Yeah.
The sunk cost fallacy is that human tendency to continue an endeavor because of invested resources, even when future evidence suggests it's illogical. The RCF rule is the antidote to that fallacy.
I see.
The moment you start thinking, oh, we've spent so much already and we have to finish it, you're making a financially unsound decision. You should only continue if the future expected returns outweigh the future expected costs from this point forward. That initial $150,000 is irrelevant to that calculation.
So if a question presents you with a table of total project costs, the very first step is always slicing off any line item that occurred prior to time 0 or the decision point. Don't let the sheer magnitude of the historical cost mislead you.
Correct. It failed the future test. It's fixed, it's unchangeable, and therefore it is non-incremental to the decision at hand.
Okay, moving on to the second crucial filter. The cash filter. This is where we kick out non-cash items. And as we noted before, the most common culprit, the classic trap in almost every investment appraisal question, is depreciation.
Depreciation, yes, or amortization for intangible assets. It is purely an accounting construct.
Right.
It is a systematic, non-cash method used to spread the cost of an asset over its useful life on the income statement, fulfilling the matching principle of accounting. But let me be perfectly clear. No cash moves when the accountant books a depreciation charge.
Zero cash.
Zero. Since DCF models net present value being the primary method deal exclusively with real cash flows, depreciation book values, so historical cost less accumulated depreciation, and any other non-cash flows must be ignored entirely in the cash flow column.
Okay, wait, I need to stop you there because this is a massive point of confusion for students.
It is.
We ignore depreciation in the cash flow column, but we absolutely factor in capital allowances, which is tax depreciation. Why do we treat them differently?
That is the perfect question, and it perfectly illustrates the difference between accounting and finance. Depreciation is an accounting expense that reduces accounting profit. Capital allowances are a state-provided incentive, a reduction in the amount of taxable profit. The capital allowance reduces the tax you owe, and paying less tax is a real cash saving. It's an inflow.
Oh, okay.
We ignore depreciation because it is non-cash. We factor in capital allowances because they generate a tangible cash flow, a tax shield. We'll cover the mechanics of that later on. But the core principle is that depreciation is irrelevant, while its tax consequence is highly relevant.
Understood. Let's move to another key non-cash item that requires explicit exclusion: interest costs.
Yeah.
This is where many students fail the cash test mentally because in the real world, interest payments are a guaranteed major cash outflow. Why do we explicitly exclude a guaranteed cost like interest from our RCF calculation?
This exclusion is absolutely critical, and it often feels counterintuitive unless you grasp the underlying theory of discounting. We exclude interest costs to avoid double counting the cost of finance.
Double counting, okay.
Think about the structure of the appraisal. When we calculate the NPV, we take the project's operational cash flows and we discount them back to the present day using the cost of capital, or WACC.
And the WACC inherently includes the cost of debt, which is where the interest comes from.
Exactly. The cost of capital, the WACC, is already set at a rate that compensates the debt providers, like banks or bondholders, for their interest payments and the equity providers for their required return.
I see.
By using this WACC as the discount rate, we are explicitly deducting the cost of finance from the project's value. If we then included interest expense inside the project's operating cash flow column as an outflow, and also used the WACC to discount those flows, we would effectively be deducting the financing cost twice.
So the discounting process itself handles the cost of finance. We only look at the operational cash flows generated by the project, separate from how the project was funded.
That's the rule. RCF focuses on project viability in isolation, the cash it generates before financing considerations. The cost of financing is handled by the discount rate. Include interest in the RCF column, and you will unjustifiably lower the NPV, perhaps causing you to reject a perfectly viable project.
Okay, now for the final and often the trickiest filter, the incremental test. This is where professional judgment truly comes into play, determining what truly changes because of the project.
It is. Direct costs are usually simple. If the question says a new machine will incur, say, new maintenance running costs of $10,000 per annum, that is clearly incremental.
Right.
That cash cost only exists because the project exists. It's a future cash incremental outflow. The complexity arises when we look at internal allocations, specifically apportion costs or general overheads.
Apportionments, the bane of every financial management student's existence.
They are. Let's use the classic example. The project is charged $35,000 per annum to cover its share of general building expenses. This might cover central services, head office rent, general administration, maybe even the CEO's salary.
Okay.
We must ask, does the total cash outflow of the entire company increase by $35,000 per annum if we accept this project?
And in most cases, probably not. That charge is just the management accountant taking the existing pool of fixed overheads and dividing it up among the various departments or projects for internal reporting.
Exactly. It's an internal transfer of cost, not a new additional cash flow for the company as a whole. The company's total cash position doesn't change just because the management accountant shuffled $35,000 from one cost center to another.
So it's not incremental.
If that general overhead cost remains exactly the same whether the project goes ahead or not, the $35,000 is irrelevant. It failed the incremental test because the total corporate cash outflow hasn't increased.
So the only way an overhead charge becomes relevant is if the project causes a direct, measurable, incremental increase, like perhaps we need to hire a brand new security guard specifically for the new facility, or buy a new company-wide insurance policy because the new asset is high risk.
Precisely. That is a new extra cash outflow. But the standard apportionment of existing fixed costs must be excluded.
Now let's contrast this irrelevance with the crucial concept of opportunity costs. This is where students often struggle because they're not direct cash costs, but they are absolutely vital to the RCF principle.
An opportunity cost represents a benefit lost or revenue foregone by choosing this project over the next best alternative use of the consumed resource.
Okay.
If accepting the project means sacrificing a guaranteed cash inflow from elsewhere in the company, that sacrificed inflow is treated as a relevant cash outflow for the project being appraised.
The incremental comparison is what matters. So if Project A uses resources that could have generated, say, X dollars net contribution for the company in Project B, then X is an incremental cost of choosing A.
Yes. Even though the money never physically left the company's bank account for Project A, it's the highest benefit we gave up.
Right.
That is the financial logic that must dominate. We must always account for the highest alternative use of any resource consumed by the project, whether that resource is cash, materials, skilled labor, or even physical space.
Okay, this is the part of the deep dive that really targets those professional marks. We're going to slow down and run through the trickiest scenarios using that detailed research project example from the source material. We need to focus on the step-by-step reasoning required to advise the managing director.
Let's do it. Let's analyze the $60,000 of materials already purchased for the research project.
Okay.
First judgment. The initial $60,000 purchase price is a clear sunk cost. It is historic and irrelevant. We start at zero cost for these materials.
Right, but now let's inject the complexity. The scenario states the materials are toxic and must be disposed of at a cost of $5,000 if they are not used in the project. If they are used, we save that $5,000 cost.
And this is the key judgment trap. We are not focusing on the original $60,000, which is sunk. We are focusing on the future consequence.
So,
If we proceed with the project, we avoid the $5,000 disposal cash outflow. An avoided future cash outflow is financially equivalent to an incremental cash inflow or a saving.
So the relevant flow isn't the cost of the materials, but the consequence of using them. The materials themselves cost the project nothing, but using them generates a $5,000 saving.
Exactly. We treat the $5,000 avoided disposal cost as a relevant cash inflow to the project at time zero, or whenever the disposal would have happened. It's an application of the avoidable cost rule, a crucial element of the incremental filter.
This is why the three filters are so important. The original cost failed the future test, but the consequence of the decision passed the future and incremental tests, which led to a relevant figure.
That's the logic.
Next, let's tackle the skilled labor transferred from a profitable production department to this new research project. This is arguably the most common and complex opportunity cost scenario in the exam.
It really is.
Yeah.
The information is layered. The workers, if returned to their original department, could generate sales of $150,000.
Okay.
These sales have a prime cost of $100,000, which includes $40,000 for the labor cost itself and $20,000 for absorbed overhead.
Let's filter the irrelevant noise first. The $20,000 absorbed overhead is almost certainly an irrelevant apportionment, so we cross that out. Now, let's look at the $40,000 labor cost. Why is that usually irrelevant?
Because skilled workers are typically salaried staff or on fixed contracts. So whether they are building product A or working on the new research project, the company is still paying the $40,000 wage bill.
I see.
That $40,000 is a fixed, non-incremental cost to the company as a whole. It's an internal transfer, not a new outflow. So we cross out the $40,000 labor cost as non-incremental.
Understood. But by taking those workers, we have prevented the company from making $150,000 in revenue. That revenue loss must be an incremental consequence.
It is, but we must look at the net consequence. The lost revenue is $150,000. However, if they had made those sales, the company would have incurred the variable costs associated with that production, primarily the materials and utilities. Since they are not making the sales, we avoid those variable costs.
So we need to calculate the loss contribution. The prime cost was $100,000. If we exclude the non-incremental labor cost of $40,000, the remaining $60,000 must be the variable expenses like raw materials that we now save.
Precisely. The avoidable variable cost is $60,000. The net cash lost is the revenue $150,000 minus the costs we avoided by stopping production, $60,000. The result is a $90,000 loss contribution.
Okay.
This $90,000 net revenue loss is the relevant opportunity cost, and it must be treated as a cash outflow for the research project.
That is a comprehensive application of the incremental test. We don't care about the wages paid, that's non-incremental. We care only about the profit lost, the $90,000 contribution foregone. This requires real analysis, not just picking numbers off a list.
It does. And if you simply added the $100,000 prime cost to the project expenses, you would understate the project's true cost by $50,000 because you'd be ignoring the revenue lost, which is the entire point of an opportunity cost.
Next, let's handle the special microscope that the project requires, which cost $18,000 3 years ago.
Immediate application of the filters. The $18,000 historical cost is irrelevant. It's sunk. Any book value, cost minus accumulated depreciation, is also irrelevant because it's a non-cash accounting figure.
The decision revolves entirely around its current alternative use, which in this case is disposal. The equipment has a current disposal value of $8,000.
So if the project goes ahead, the company loses the immediate opportunity to sell the microscope for $8,000 cash now. That $8,000 is a clear, immediate opportunity cost, and it is a cash outflow at time zero for the research project.
So the project is charged for it.
The company must charge the project $8,000 for using that asset, yes.
And what about the future disposal value? The scenario mentions that if it's used for the project, its disposal value in 1 year is estimated at $6,000.
That future value is also relevant. It represents a future cash inflow from the sale of the asset at the end of the project's short life. So the equipment contributes an $8,000 outflow at time zero, the opportunity cost of not selling now, and a $6,000 inflow at the end of the project, its scrap value. Both are relevant future incremental cash flows.
And the cost of using the asset is measured by?
The loss proceeds at time zero, which is the $8,000 current market value.
So the relevant flows here are derived purely from market values and future consequences, completely ignoring the historical cost and book depreciation.
That's it.
Okay, let's summarize the final elements of this example, because they perfectly contrast irrelevance and relevance when it comes to fixed resources.
Right. We already established the general building services charge of $35,000 per annum is irrelevant because it is a non-incremental apportionment.
But the physical space that the research project occupies has an alternative use. If the project is discontinued, the space could be sublet for an annual rental of $7,000.
And this is a classic opportunity cost arising from physical resources. If the project proceeds, the company loses $7,000 of guaranteed annual rental income.
Right.
This lost rental is a measurable future cash inflow that we sacrifice if we accept the project. Therefore, the $7,000 per annum lost rental income is an incremental opportunity cost. It's treated as a recurring cash outflow for the project's duration.
The lesson here is so profound. A massive $35,000 internal cost transfer is irrelevant, while a smaller $7,000 real cash flow foregone is entirely irrelevant.
It is.
RCF demands that we look through internal accounting conventions to find the real impact on the company's bank account.
Exactly. Focus on the actual cash consequences, not the management accounting labels.
Okay, let's pivot now to the two major categories that always appear in full NPV calculation questions in Section C, and which carry significant marks: working capital and tax. These aren't so much about filtering irrelevant information, but about getting the timing and the mechanical treatment absolutely correct.
Absolutely. Let's start with working capital. WC represents the immediate cash tied up in the operational liquidity needs of a new project. So, funding the expansion of inventory, covering accounts receivable balances, or building up cash balances before sales revenue generates positive flows.
It's a very distinct movement of cash.
It is, and it requires specific modeling.
So how should we model the basic working capital flow?
In a standard scenario, WC is typically an immediate outflow at the start at time zero, representing the cash injection needed to get operations running.
Okay.
And then, crucially, it is fully recovered as an equal inflow at the end of the project's economic life.
Let's use the example. A machine costs $100,000, and $20,000 additional working capital is required at the start.
That $20,000 is an immediate capital requirement, a cash outflow at time zero. It is just as relevant as the machine cost itself.
And at the end,
if the project lasts 4 years, that $20,000 is then recovered as an inflow at the end of year 4. The financial logic is that once the project ceases, the remaining inventory is sold off, the customers pay their outstanding debts, and that initial cash requirement is released back into the company's general pool of available funds.
Okay, now let's explore the critical examiner trap related to that recovery assumption. This is a huge professional judgment mark opportunity.
This is vital. The standard assumption is recovery, but the source material highlights this trap. If the question states the machine will be replaced at the end of its life, this implies that the product line and the overall production process will continue seamlessly into the next project cycle.
So if production continues, the need for that pool of working capital doesn't just disappear. The liquidity is still needed to fund the ongoing inventory and receivable cycle.
Precisely. If the product will continue, the working capital will still be needed by the replacement project. The cash remains tied up in the business cycle. In that critical scenario, you should not recover the working capital at the end of the project.
Okay.
You must clearly state in your workings or your justification that recovery is ignored because production is continuing. This single sentence in a question can completely change the NPV result and is a pure test of your financial judgment.
And sometimes working capital requirements aren't just one lump sum at the start, are they? They might increase incrementally over the life of the project.
That's a great point.
If WC needs to increase from 20,000 to 30,000 in year 2, how do we model that?
You only model the incremental change in cash flow. So if WC is 20,000 at time 0, that's an outflow of 20K, and then the requirement increases to 30,000 at the start of year 2, you would model an additional outflow of 10,000 at time 1, which covers year 2's operations.
Ah, so it's always the change.
You are always dealing with the change needed to fund the new total requirement. Then, when the project ends, the full 30,000 required at that point would be recovered, unless, of course, that replacement trap applies.
Okay, now for the other big one. We established that depreciation is irrelevant, but tax is a massive, highly relevant cash flow. Why does the tax calculation become one of the most mechanically demanding parts of investment appraisal?
Because there are two distinct interlinked tax effects that must be carefully modeled as cash flows, and their timing is almost always staggered.
Okay, what's the first one?
First, the project generates extra revenue and profit. This results in extra tax payable, which is a cash outflow. This is calculated on the project's net operating cash flow.
And the second?
Second, the initial capital investment in the assets, the machines, the plant, generates capital allowances. This is the government's way of allowing you to deduct the asset's cost from taxable profit, often faster than accounting depreciation.
Right.
This reduces the company's overall taxable profit, resulting in less tax payable, which we treat as a tax saving or cash inflow specific to the project. This is the tax shield.
So we have the initial cost of the asset going out at time 0, and then the tax benefits derived from that asset purchase coming later, depending on the allowance method and the payment timing.
And the timing is key. The ACCA FM exam makes simplifying assumptions you must adhere to. The calculation is often based on operating cash flows, so revenue minus incremental costs. Crucially, tax is usually paid 1 year in arrears.
Always watch out for that.
Always. This means year 1 profit tax is an outflow in year 2, year 2 profit tax is an outflow in year 3, and so on. This lagging effect is critical for MTV because a flow received later is worth less today.
Let's discuss the capital allowances themselves. The exam will usually specify either a straight-line basis or a reducing balance basis. Why is the choice of basis relevant to the NPV?
The total tax shield over the life of the asset is the same regardless of the method. It always equals the asset cost minus the final scrap value. But the timing of the allowances changes dramatically. If the examiner specifies straight line, the tax saving, which is the tax rate times the capital allowance, is steady each year. The cash flow is predictable.
But with reducing balance.
If the examiner specifies reducing balance, a much higher allowance is given in the early years. This creates a larger tax shield cash inflow sooner. And because cash flows in the early years are discounted less heavily, the reducing balance method typically generates a higher NPV than the straight line method for the same project.
And that difference is a crucial application of the time value of money concept.
It is.
So reading the tax rules, the rate, the timing, arrears or not, and the capital allowance basis is paramount. These factors determine the ultimate timing and magnitude of 2 of the largest cash flows in any full appraisal question.
Absolutely. Remember the ultimate goal. Calculate the tax shield cash flow, which is essentially the tax rate multiplied by the annual capital allowance claimed, and make sure you shift that payment or saving 1 period into the future if the 1 year in arrears rule is applied.
We've covered a tremendous amount of ground here, moving from the philosophical bedrock of RCF to the complex, nuanced mechanics of opportunity costs, working capital timing, and tax shields. Let's bring it all together now. The goal is maximizing those professional marks by demonstrating logical judgment. What is the guaranteed strategy for tackling RCF questions, especially the constructed response questions in Section C that require justification?
The strategy must be structured, transparent, and defensible. You need a clear methodology that signals to the examiner that you didn't just guess the numbers, but that you applied the financial management principles rigorously.
Okay.
When we teach this, we break it down into 4 non-negotiable steps.
Step 1. Always reinforce the foundation.
Step 1. Define the rule. State the RCF principle clearly, either as an opening sentence in your justification or just as a mental checkpoint for yourself. Relevant flows are future, incremental, and cash. This sets the analytical standard, and it shows the marker, the basis of your judgment.
Okay, step 2. Don't let the complexity of the scenario overwhelm you.
Step 2. Systematic review. Go through each line item in the scenario one by one. Don't try to lump items together initially. Treat the historic cost, the depreciation, the absorbed overhead, and the equipment disposal value individually, even if they end up sharing the same outcome of exclusion. Your written response must address every single item mentioned.
And then comes the vital part, the justification.
Step 3. Justify exclusion. The why not. For every irrelevant item, sunk cost, apportionment, depreciation, book value, interest, explain why it fails the RCF test and use the technical terms.
So don't just say ignore it.
No. For example, don't just write, ignore the $150,000 research cost. You should write, the $150,000 historical research cost is irrelevant as it is a sunk cost. The decision to proceed now cannot recover this past expenditure. Therefore, it fails the future test.
And conversely, for relevant items, we must justify why we do include them.
Step 4. Calculate relevance and justify inclusion. The why. For relevant items like an opportunity cost or a material saving or working capital, state the cash flow amount and justify why it is included, tying it back to the core principles.
For instance,
the $90,000 lost contribution from transferring skilled labor is a relevant opportunity cost. This cash inflow is foregone by accepting the project, making it an incremental cash outflow that must be charged to the appraisal.
I think the key confidence boost for you as a listener here is realizing that in the FM exam, focusing on the reasoning behind the inclusion or exclusion of items is often worth more marks than the calculation itself.
Absolutely.
The logic is the highest value commodity.
It truly is. If you feel you are spending more time writing the explanation and the justification than running the calculation, you're probably on the right track for maximizing those professional marks. The arithmetic must be correct, of course, but the demonstration of sound professional judgment is paramount.
This has been an incredibly detailed and, I really hope, confidence-boosting deep dive into relevant cash flows. We didn't just skim the rules, we dissected the logic behind the 3 foundational filters: future, incremental, and cash. We armed ourselves with the necessary judgment to filter out common pitfalls like sunk costs, overhead apportionments, and non-cash flows, and provided clear strategies for handling the critical complications of working capital timing and the dual effects of tax and capital allowances.
A lot of ground covered.
Now for the final, provocative thought that builds on this material. We focused entirely today on using RCF to accurately assess the internal viability of a new project to see if it yields a positive NPV. But we must never forget the bigger picture.
Right.
How does this critical financial management function, deciding whether to invest, connect with the broader, ultimate financial objective of the firm, which is maximizing shareholder wealth?
The connection is direct, and it's absolute. Maximizing shareholder wealth means taking all projects with a positive NPV. The accuracy of your relevant cash flow calculation is the operational link to fulfilling that ultimate objective.
Okay.
If you miscalculate RCF, perhaps, by ignoring a hidden opportunity cost, and you reject a project that would have increased NPV, you have failed to maximize shareholder wealth by foregoing a positive value addition.
And conversely,
including irrelevant sunk costs can artificially push down a good project's NPV, also leading to a failure to maximize wealth. RCF is not just an exam topic. It is the essential financial discipline that dictates whether the company succeeds in its core mission of value creation.
A perfectly calculated and justified NPV, then, is a direct measure of whether you have fulfilled that responsibility. That clarity and structure should give you a huge confidence boost as you approach your exam.
I hope so.
We want to make sure you have all the tools you need to pass. For more guidance and extensive resources designed specifically to boost your confidence in ACCA exams, remember to subscribe to the SmartPass YouTube channel at https://www.youtube.com/@SmartPassACCA. Prep for expert video explanations that walk through these complex concepts step by step.
They're a great resource.
Also, follow SmartPass on Instagram at HTECA/www.instagram.com/ACCA.smart.pass for daily ACCA exam tips and reminders designed to keep you exam ready. And finally, access premium ACCA FM study kits and detailed exam strategies on Gumroad at https://ACCA/smartpass.gumroad.com. Get that extra edge to master these concepts and secure your pass. Thank you for joining us for the deep dive. We'll be back soon with another essential topic.